we are 2 days into the last quarter of the year. You are in a nice seat, and as much as you have a better view into the future than most of us, at least it relates to M&A, what should we be expecting going into the end of the year?
Well, listen, I think it's been a very volatile time, and I think one of the themes that we see playing through is tale of haves and have-nots. So if you are a double B corporate in a very strong industry, you're going to have a very strong receptivity in the credit markets. If you're a tougher credit at the lower end of the credit quality, it's going to be very challenging. But we're seeing great demand for that high double B and even very well-structured sponsored transactions, and then a bifurcation with the lower credit quality. But we're actually cautiously optimistic that credit, even in a day like this, very volatile, which I'm sure you've been following.
I didn't want to make that the top, though. Down 3% in the market.
Yeah,
What does it mean
you
for
picked a great day for this interview.
I know, that's our trend.
But that credit's actually performing relatively well.
But what is that reflective of? Is that just because there's some sort of fear in the market about where we're headed, or does that reflect the fact that we've actually had a relatively good year thus far? People have taken money off the table and don't want to take that risk.
Here's what I would say. The credit investors have had a remarkably good year. I was surprised myself when I looked last night to see IG is up 13%, investment grade up 13%, high yield up 12%, and loans up 7%. That's a very good year in credit. So yes, I think folks are feeling very good about the world, but they also have a very good technical backdrop. There was a fairly heavy calendar coming post-Labor Day, and then that's worked its way down on a forward basis to probably close to $45 billion. And on a net basis, when we back out refinancings, it's in the low teens. In addition, there's cash in the market. I'm sure people have commented all year that the high yield market has been experiencing inflows. So that's another reason why the high yield bid is so strong, particularly for strong credits.
Let's talk about deals for a moment. One of the trends we've seen this year and indeed over the last few years is a sort of growing aggression around M&A, whether that's through activism, whether it's disgruntled shareholders, whether it's interlopers, regulatory risk, etc. But it's had the effect of pulling deals out longer, creating more risk around closing certainty. How does that affect the lending banks like yourself?
Here's what I would say. I think deals are harder to get done for all the reasons you cite. And what we spend our time at Goldman Sachs focusing on is how do we create the great solution for the client. And so we spend our time working very closely with our M&A colleagues and with the financing side of the house. And so when we're thinking about accessing the markets, we're very nimble. We think about geographies, we think about bonds, loans, and we also think about, is there a way for us to avail our clients' needs of our merchant banking division? And I think we've talked about this in the past. We're the unique investment bank that has a direct lending platform. In fact, we're the largest performing credit direct lender in the world with $43 billion. And what that means is when we underwrite a transaction, if there's an opportunity to de-risk a portion of the capital structure, that means going into a market, we've sort of de-risked potentially the most risky part of the capital structure.
How much of your business is now going over to the merchant bank?
We've had a JV with the merchant bank going back many years. I think it's actually almost 15 years old. It's a really important part of our product suite in the investment banking division. And I would say this year, a number of our transactions have been underwriting of the first lien loan portion of the capital structure, and then the merchant bank will take a second lien. I'll just give you a stat that gives you, I think, a little sense for how much of the second lien market's going direct. Through Labor Day, there were only 12 second liens that were distributed to the market. The rest of them were directly placed. Now, they didn't all go to Goldman Sachs. There are lots of very large direct lenders as well. But that just gives you an indication that the sponsors in particular really like the de-risking element of the direct lending market.
But what would a normal calendar year up to this point be if 12 was this year?
Last year, I think the number was close to 50.
Okay, so a real decline. And how much of the market at the moment are the direct lenders representing? Because there are obvious appeals to the sponsors for direct lenders who disintermediate, essentially two other players in the market. It's cleaner. There's simplicity there. So how much of it are they taking?
I haven't seen any public stats, but my suspicion in the sponsor market, where they're predominantly doing first and second lien transactions, the direct lender is growing probably plus 20, 30% of the market. But keep in mind, the corporate market does not avail itself on most cases for the direct lenders.
Now, I know the direct lenders would say, look, a lot of us patient capital, indeed some permanent capital, yet they have only been around at least at scale in a pretty resilient market and a pretty safe and stable market. As it grows, are there concerns that if we do go into a downturn and a recession, the direct lending business will be really, really unable to sustain?
I think in a downturn, what you would see is some pressure on liquidity. If folks needed to find liquidity, the investment banks obviously have big trading platforms, the direct lenders don't. So that would be something to watch carefully. But again, I think we still have a very robust agent inside of the market, so we're pretty optimistic.